A great dividend portfolio is the topic of today's presentation. And if you're somebody that's invested in dividend growth investing stocks or thinking about a dividend growth strategy, then you'll want to watch this because today we're going to look at how to create a dividend portfolio with the optimal risk-reward profile. So this presentation is going to be based on a very exciting paper we're working on with a French business school, and we're currently in the process of reviewing it and potentially publishing, and it's based on Quantigence, our dividend growth strategy. And what we're doing there is utilizing academic research to support our portfolio construction method. So today we're going to look at some basic principles of portfolio construction, things like industry diversification, choosing the optimal number of stocks, equal weighting versus market cap weighting, and rebalancing. So when we look at dividend-paying stocks, it's quite simple. A company's operations start out burning cash as the business scales. So this is the traditional disruptive growth business that we would cover it and analyze. When those companies mature, they start returning money to investors because that makes better sense. The growth days are over. Now, before you can return money to shareholders, it makes sense that your business is generating positive operating cash flows. That's where the money comes from. These differ from profits because they're arguably more true. So some of the cash generated by a business is reinvested back into the business, but not all. That's a growth company. The remaining is free cash flow that can be returned to investors. So I like this slide from Johnson & Johnson, which shows their capital allocation strategy. So you see there at the top, it says organic growth business needs. That's referred to as CapEx, right? Capital expenditures. Money they need to reinvest for organic growth. What's left over? That's free cash flow. And from that, they can take two different paths here. The first you see on the left, investment in mergers and acquisitions. That's acquiring growth. And on the right there, they say competitive dividends and share repurchases in that priority order. They've now increased their dividends for 61 years in a row. So that's a track record that they're going to want to keep. That points to the most important rule in our dividend growth investing strategy is that yield means nothing unless it's predictable. So you'll see people search for articles like best yielding stocks or highest yielding stocks. Makes no sense whatsoever because dividends mean very little if they're random. So you could pay $5 today, $1 tomorrow, and $5 the next day. And every time that you declare those dividends, that yield changes, and it either looks high or small, and the number means nothing because you don't know what the next dividend payout is going to be. So you can't rely on that yield. Now, typically, the higher yield a company has, the less likely they'll maintain or increase it. Generally speaking, VFC was a classic example we looked at where their yield was getting suspiciously high. We published a piece on that, and they eventually ended up losing their dividend champion status, something that's quite rare. Another company we looked at in a similar situation is 3M. I think their dividend is approaching 7%, and that can either be a value trap or an opportunity. We did a piece on that as well. Now, companies that have a track record of increasing their dividends over time will outperform because those have become predictable income streams. And when we talk about consistency, a good track record starts at about 25 years of increasing, not just paying, increasing the dividend every year consistently in a row. Companies that accomplish that feat are called Dividend Champions or Dividend Aristocrats, the latter being a name given to that classification by the S&P 500. There are around 84 companies that have this status. That means they've increased their dividends for 25 years or more in a row. When you compare that to the global universe of around 9,000 stocks, then that's a very elite group. This slide here shows you what dividend growth looks like in practice. So there's some popular dividend growth names, and you can see based on the dividends paid per share, you can very easily calculate the compound annual growth rate at a 5-year and a 10-year level. This was put together by one of our subscribers who's building his own dividend growth portfolio. We've also built our own, and this is a slide which shows our portfolio average, the table there on the left. across the 7 factors we use in our strategy, years increasing dividends. This is remarkable. So the average company, out of 30 companies we're holding, the average company has increased their dividend for 47 years in a row. And then you can read to the right of that. But what I wanted to point out here that's interesting is the effects of growth over time. That's, as I said, the most important rule is that growth track record and the effects that will have on your portfolio. Take a look here. So 5-year dividend growth of 8.1%. That happens to be the table that you see on the right. That's a dividend stream growing at 8.1%. So you can see it starts out in year zero at $1,000. After 10 years, your income has doubled, and then you can read down. You see after 40 years, it's more than 20 times. So just imagine this strategy working over multiple decades and the sort of income that you'd be realizing from it without even having touched your principal. Now, we're going to talk a little bit about how the principal behaves over time, but I wanted to take a second here and ask you, we don't run ads on this channel, so we need your help to support our work. So please like this video. That helps spread the message. And also, if you subscribe to this channel, we're going to be putting out more information over time on the work that we're doing on this paper in our Quantigence dividend growth investing strategy that you can see here. There is a report for this strategy that's available to Nanalyze annual premium subscribers. So please bear that in mind if you're interested in learning more and you want to support our work with a paid subscription. Now, let's talk about industry diversification. This is a classification standard that's very near and dear to my heart. I spent over a decade working at the company that built this alongside S&P 500, and it's used to classify stocks according to what they do. And you can read from left to right here the various sectors: energy, materials, industrials, discretionary, staples, healthcare, etc. And you can see how that goes down and starts breaking down into additional industry groups, industries, and sub-industries. It's a very interesting method of classifying companies, but let's keep it at the top level and take a look at this correlation matrix. So it reads very simple. If you go to the upper left, you can see that consumer discretionary, of course, is purely correlated to consumer discretionary, right? That's a correlation of 1. That's going to be pure green. And then if you read all the way over to the right, consumer discretionary against utilities, see how they're negatively correlated to a certain extent there, which means that they provide a diversification effect. So, well, utilities may be going down, consumer discretionary will be going up. So the fact that all these industries aren't very positively correlated with one another means that you want to hold them all for maximum diversification purposes. So when we look at the steps to building a great dividend portfolio, the first thing we need to do is decide how many stocks we want to hold. Well, there's the myth of 30, which says that financial pundits often talk about 30 stocks being the optimal number for diversification, but that was just a often repeated myth. Now, the reason that we use 30 in our portfolio is that eventually we'd like to base an ETF off of that, and 30 stocks starts to resemble a number that you might be able to do that with. Now, you should have arguably at least 10 stocks. That's 1 per industry, and let's say 1 per sector. You may say, well, there's actually 11 sectors. You're absolutely right. However, in our dividend growth investing universe, the communications services sector doesn't actually have any champions in it, so it's actually 10 industries. We believe industry diversification is important for the reasons shown on the slide with that correlation metric. So let's say that 10 would at least be the minimum you ought to hold. And this chart here on the right is a classic textbook chart you'll see pointing to the optimal number being anywhere from 20 to 25. The maximum is less important. The minimum is more important. So in order to kind of nail this down, I looked up a study by the venerable CFA Institute that says for large cap portfolios, there's little to be gained by diversifying beyond 15 stocks or so. For small caps, so that's anything between 250 million and 2 billion, peak diversification is achieved with around 26 stocks. So the takeaway here is it really comes down to preference. Anywhere from 10 to 30 are desirable. If you listen to what the CFAs have to say, then around 15 would be your sweet spot. Now, when you look at the champions, so those are companies that have increased their dividend for at least 25 years in a row, champions by sector, you see here that some sectors have more than others. So there's a lot of selection there in consumer staples. There's selection in industrials, as I said, nothing in communication services, 3 companies in energy. So really, you have 84 dividend champions to choose from, which are plenty when it comes to putting together a great dividend growth portfolio. Now, when it comes to how you're going to weight it, when you decide on the number of stocks that you'd like, there's really 2 weighting schemes. Now, I worked with MSCI for over a decade, and every single one of our indices, the often used MSCI global indices, were always market cap weighted. Now, the equal weighting scheme, which simply says ignore market cap and do an equal weighting in each company, is also known as naive diversification. And what it does is it mitigates the concentration of non-systematic risk in a portfolio, especially when you include at least 30 to 40 randomly selected stocks, or in that range. So an equal weighting scheme might work well for us. What it also does is that it results in a greater exposure to smaller capitalization stocks. Not small caps, but smaller capitalization. Remember, because if you're weighting by market cap, then you'd give the most weighting to the biggest company. So what that does is it allows you to benefit from some of the, let's say, numerous studies that have pointed to small cap companies often outperforming large cap equities on a risk-adjusted basis. So think of Sharpe ratio, the amount of risk you're taking for the rewards that you're getting. When you get down to the nano cap level, that changes. You take on more risk by holding nano caps than the benefit that you get. So consequently, equally weighted portfolios tend to exhibit higher volatility and superior performance because they overweight smaller size stocks compared to value weighted portfolios. That's what our research showed in this paper. Now, one of the things that we looked at quite a bit was how to rebalance a portfolio. And for those of you that are familiar with our Quantigence strategy, you'll know that this is one of our to-dos, to figure out a rebalancing method that's systematic. So another noteworthy characteristic of an equally weighted portfolio is its inherent buy low, sell high aspect, stemming from a rebalancing process that's required to maintain equal weight. So you may add all those stocks to your portfolio. If you're using dollar cost averaging, it'll change over time, and you can actually adjust your contributions based on that. But if you're trying to keep those all balanced and you have a runner, let's say like NextEra Energy, which had quite the growth spurt there, it may suddenly get very large in terms of its percentage weighting in your portfolio compared to other companies, and you may want to trim that. And what happens there is that this equal weighting strategy ends up functioning as a trading strategy, so that when you're trimming stocks that are outperforming and you're putting that money into stocks that are lower weighting, so you say outperforming, you're simply looking at weightings. It could be relative, right? But you're saying the companies that are at the heaviest weighting, if you trim those and you add that money back into the companies with the lower weighting, then essentially what you're doing is selling shares of stocks that have increased in value and purchasing more of those that have declined. So effectively you're locking in gains and increasing your exposure to cheaper stocks. That only works. You say, what's the difference between that and market timing? Well, this works only if it's systematic, as we said, to eliminate the human bias element. So what we found is that equally weighted portfolios tend to offer superior returns compared to value-weighted portfolios, and that supports our method here at Nanalyze, our dividend growth investing strategy, which uses equal weightings. Now, objective trimming rules. We need to think about how we want to come up with these. And let's consider a portfolio size of N stocks. So N happens to be the number you've decided to hold. Well, you can get your target weighting by 1 divided by N. So our portfolio has 30 stocks. 1 divided by 30 is 3.33% target weighting. So at what weighting would we want to trim? Well, I just looked at the portfolio right before this video, and I see that one of our holdings is at 5.1%. So we've been trimming, and that probably wouldn't result in any action, but let's say it starts to get into 5.5 or up. We'll probably then start trimming that. We have in the past. You could make that objective and say, well, if it's twice a position size, that's probably reasonable. You wouldn't want anything to get more than twice a position size, I think. So that would be 6.66% in our case. But the idea there would be to come up with a rule so that it becomes systematic. And the literature has shown, so there was a study that looked at how often you want to trim and rebalance, and it proves, let's say the academic evidence shows that a quarterly rebalancing date is the most lucrative in terms of shorter term rebalancing timeframes, anything under a year. So what we found appealing about that is that quarterly rebalancing would be optimal for an ETF. If we ever wanted to run an ETF on our strategy, we'd need that trimming method to be entirely rules-based. So that's what we've been looking at. Now, applying these best practices to our own methods, we see that we're well on track with the way that our strategy has been evolving so far. Our industry diversification approach, so in our report, our Quantigence report, you can see where we go through every one of those industries except for communication services because there's no constituents. And then we rank the members of each sector, and then we choose members based on our Q score. So that's all part of our strategy. 10 to 26 stocks is a desirable range just based on the information from the CFA Institute, though if you're thinking about running any sort of a strategy on a product, then you probably want to have 30 names or so. Round numbers are very simple. A portfolio is always a percentage of your total AUM. So if you had a portfolio of stocks and had 10, that means that each of those positions would be 10%. Well, we said before, you should never have a position of any kind, and when it comes to a single equity, that's higher than 10% of your total assets under market. So as long as that portfolio is just a portion of your total wealth, then having 10 stocks is fine, but anything that starts to get above 10% represents too much risk. Equal weighting, as we said, is preferable to market cap weighting. That's simple to follow for retail investors. We keep things very simple. It's easy to maintain over time, and it just requires rebalancing rules. So once a quarter, take a look at where you're sitting there in terms of weightings and do a rebalance. Quarterly rebalancing is the optimal frequency, and using target weightings is an acceptable method. Now, just to conclude, a great dividend portfolio must contain a diversified set of dividend growth stocks, 10 or more. Industry diversification provides stability in the face of macroeconomic and microeconomic factors. Academic research that we've looked at has so far supports our methods of dividend growth portfolio construction and adds more credibility to our strategy. Stay tuned for future presentations we're going to look at because these will examine performance over time, and the results are rather spectacular. So I'm going to put up another video here for you to watch. Before I do that, please click the Nanalyze logo on the right. Support our channel. We don't run ads. We need that help. Thanks so much for taking the time to watch this today.